Well, good morning, everyone. Thomas Montgomery. We get together with our distribution partners most weekday mornings at this time, 8 o'clock Central, to talk about strategies, tips, techniques, share success stories, and such. Today is Tuesday, May 24th, and we are jumping back into the topic that we started last week on the 125 steps. So let me go up to the top. What we had initially launched earlier last week was this 125-step checklist for launching a business. I can make it a bit larger. And so this is a step-by-step guide that you can use if you're a white label partner and mentoring clients, or if you just have general information in what many would consider the most comprehensive step-by-step guide to get a business set up and launched to be able to access capital. With that being said, different people have different opinions. Maybe you have 127 steps in yours, but this is what the committee put together, and I am the messenger bringing it forth. Of course, we want to start all participants by getting them engaged. If you're a referral partner, you'll send them to most often fundingproposal.online so they can get that initial round of funding so they have some working capital to work with. If in contrast, you are a white label partner, you will get them under agreement with you, and then we'll proceed with the steps. When we initially planned to go through this, we figured that we would go through each of these 125 steps on these morning trainings, but it is taking a while to go through it. And so we received some pushback, and a number of you had asked, let's focus on the most important topics for the entire group. And then those of you that are white label partners that need and frankly qualify for all the training and all the support of all the steps, then we'll be working with you outside of this 8 a.m. Zoom. So we've gone through a number of the steps, and we are on, let's go down to page back where we were, which was on let's see, now I forget where I was. It was step, was it 48? Let me go back to it. We'll find it here in just a second. Interviewing accountants. We're going to be on bankers today. So give me just a second here and we'll land that. Oh, starting bookkeeping records. That's where we were. Sorry. Yeah, there's all kinds of great information as far as how to select the right type of entity, how to choose the right accountant. But today, our topic is on number 47, which is starting bookkeeping records. If your experience in mentoring clients is similar to mine, often what you'll find is that we work frequently with early stage entrepreneurs, which is fine. And a lot of them have not set up the systems to run their business like a business. And so we address this in module 3, because remember, when clients come in, we go through the 4-module process. It takes 28 days to work through that. Module 1's on business planning, module 2's on building business credit, module 3's on financial management, which is what I just referenced. Module 4 is banking and money and pulling it all together. Well, on module 3, we explain that it's important to run a business like a business, and part of that is how you track your money. And so many small businesses will use QuickBooks. We don't have any financial interest in QuickBooks, and QuickBooks has competitors. And in fact, when I'm mentoring clients, I explain to them there's really 3 ways to go about this. You could outsource your bookkeeping, if you will, to a bookkeeper or an accountant, to CPA. But that while you may in fact need that professional assistance, unless you're really willing to distance yourself from the financial management, full outsourcing is not the norm. The other is to get a software like QuickBooks, which we'll talk about, and that works well and it's very affordable. And then the other alternative, you could always hire someone that's an employee of yours. But many of the clients we work with are in the earlier stage, so they're probably not yet ready to hire a full-time or a part-time in-house bookkeeper. The pushback that I often hear, and you probably see sometimes too, is the client will take a position of ignorance. And I mean that respectfully, like, well, I'm an early stage business. I don't have financial records. I don't need financial records. Well, if what we're trying to do is position your business to be credible on paper, if what we're trying to do is position your business to be ready for funding, then we need to comply with what the expectations of the banking and lending community is. And that includes the ability to generate financial reports. There are three primary financial reports, and all of them are easily created through software programs like QuickBooks. We have our balance sheets, our income statements, and our statements of cash flow. The balance sheet, and I know I'm preaching to the choir here, but balance sheets show assets and liabilities. So assets are those things that the business owns that are of value. Liabilities are those debts that the business has. So owns is assets, owes, O-W-E-S, are the liabilities. And also the balance sheet should show what the owner has contributed. That's in contrast to what we call the income statement, sometimes called profit and loss. Those mean the same. Income statement, profit and loss, same thing. And that's where we're showing income coming in and expenses going out. So a lot of small business owners don't have the training and background that you and I have. And so they may not understand even those differences, but they're thinking, well, my business doesn't have anything yet, so I can't produce these reports. Well, if we're to the point that we formed the business entity, which was one of the lessons we skipped over here, but we could always come back to that. But if you form the business entity, well, let's go through the 4 steps. If we want to create a new entity, how do we birth an entity? First, we need to pick a commercial address, a unique commercial address. Number 2, we need to file with the Secretary of State. Number 3, we file with the IRS to get our EIN. And number 4, we open the business bank account. Once we've done those 4 steps, we should be able to start producing financial reports. Now, the reports may not look real strong, and maybe we haven't sold a single product, good, or service to a customer yet, so there's no revenue, but that doesn't mean that we can't generate the reports. We cannot lie, cheat, or steal when it comes to generating these reports. These reports need to be accurate, and we need to be able to generate the reports. Now, there are legal and ethical and moral ways to improve how these reports look, all consistent with GAAP. Any of you that took accounting in college or graduate school knows about GAAP, generally agreed upon accounting principles. So we want to follow the rules, but there's ways to make those reports look better if they don't look very good. But it starts with generating how they look as a baseline. If we're not using software like QuickBooks, not using an accountant, then it's very difficult to generate reports that are accurate. So let's go ahead and see what the committee said about bookkeeping records, and we'll talk more about it. It says, or they say, ineffective cash flow management is often the challenge that keeps businesses from growing. It is also the #1 reason businesses fail. So you can see it's not just about we need financial reports to get funding, to get loans. We need to manage our business money. Now, the argument might be, well, my business doesn't have any money to manage. Well, that's a problem and we need to resolve it, and we always can. Continuing on. Good bookkeeping is the best way to combat cash flow challenges. A weekly assessment of receipts, accounts payable, and receivables is a vital aspect of running such a business. Though bookkeeping can be managed by the owner, it's best to hire a full or part-time bookkeeper and independent contractor. Constant communication with the bookkeeper and the accountant is mandatory. The bookkeeper is the internal financial manager, while the accountant acts as the intermediary between the business and government agencies. A CPA can help map out a plan for summarizing, filing, and analyzing the financial results. Good bookkeeping is evident in profitable and well-run organizations. I think this is a great sentence here, that this is a powerful reason why you and I, as mentors and technical advisors of small businesses, want to almost insist that our clients put a system in place like QuickBooks. Now, we don't sell QuickBooks or QuickBooks advisory services, so there's no conflict of interest. I'm not sitting here kind of getting you ready for an upsell. But from your perspective, if you're mentoring with clients, I would strongly recommend that you have some CPA relationships that you can refer to them and they can refer to you. And also, you may, in fact, want to build that into part of your scope of services. You could provide the bookkeeping services if you wanted. It's not something that we want to do, but you may want to do. Well, why would you want to do that? Well, every small business needs help with bookkeeping, and a lot of these folks aren't ready to do it internally yet. It's an extra revenue stream, and it's a great way to build some glue into the relationship, right? Because if you're managing their finances, they're pretty likely to stick with you. All right, so furthermore, accounting has morphed into information organization. Is not just the financial results of the business, but access to contacts, customers, and referral sources. Transcending access includes how information is gathered and used in the companies. It starts with the management, who does what. All right, also having good bookkeeping helps prevent fraud, protects the company data. So let's talk some more about this. Not specifically referring to the sheet here. So you and I are technical advisors, especially if you're a white label partner. As a white label partner, it is important that we're helping the client not only access the funding that they need to start to grow to reach their potential, but also to be successful going forward. And having bookkeeping records, and again, I'll just generally recommend QuickBooks, is a great way to go. It's very inexpensive. It's fairly easy to learn. I'll go out on a limb and say pretty much every CPA is familiar with QuickBooks, and so that allows for good interfacing where the small business can do what they're comfortable doing. They can share access to their CPA that can do those other activities that need to be done. What you and I know is when we're taking clients through the 4-week process to build their loan package, one of the reports that's especially important that comes about again in module 3 is specifically the balance sheet. Well, why is a balance sheet important? Well, the balance sheet, again, as we stated earlier in this conversation, shows what the business owes and what it owns. So let's role play a little bit. You could have a client that would say, well, we've got a number of clients on here. Let's say we have Joseph. Joseph's one of our top white label partners out of Arkansas. He's a licensed realtor. So let's pretend Joseph's a new client. And Joseph says to me, and I'm his mentor, well, I don't have a balance sheet because my business has nothing. And I'd say, well, Joseph, so what you're telling me is that your business has no debts right now. Is that correct? And Joseph says, well, yeah, I just told you that. Well, that's great, right? Because the banker could be worried about that. How much debt has Joseph and his business already taken on that could be a problem? So the fact that Joseph's balance sheet shows 0 liabilities is great. It shows that he's not carrying any debt load with the business. So in the beginning of the conversation, Joseph, the client, the combative client in this role play, is saying, well, this is bullshit. This doesn't apply to me. Well, it does. Don't you think that the lender would want to know how much debt the borrower already has? Again, the borrower, we're assuming, is the business. Well, of course they would. They want to know how leveraged you are. So, and it's okay if you already have some loans and debt and obligations. So I'm not saying that's the deal breaker, but it's valuable for, it's not just valuable, it's instrumental that the lender knows how much debt the client already has, the borrower already has. So it's like, oh, okay, well, that makes sense. Now then we switch over to the other side of the accounting equation, assets. And again, in this role play, combative Joseph, the client might say, well, my business doesn't have any assets. I've told you it's a new start business. What the F's wrong with you, right? Well, Joseph, calm down, calm down. Have you opened your business bank account? Well, yeah, I told you that. Do you have at least $1 in your business bank account, Joseph? Well, yeah. Well, then your business has some assets, doesn't it? The cash is our assets, accounts receivable are assets, equipment, real estate, and so forth. And so it's very rare that a business that is set up, meaning that they have the filing with the state, the filing with the federal government for the EIN, and they have their business bank account, to have literally no assets. Now, they might not have many assets, and maybe they're a little bit, the borrower, the client that you and I are working with, maybe a little bit self-conscious about that. It doesn't feel good, but we need to start with truth, and then we can build and optimize. So in that example, now Joseph understands, well, the balance sheet is important because we can show the lender that we're not carrying any or much debt already. And then also we can show them accurately what assets we have. Let's say that Joseph, again, we're just role playing. Joseph doesn't need any money. He's a big hitter, but let's just say Joseph wanted $100,000. And so we look at his business balance sheet and we realize, uh-oh, he doesn't have enough collateral. So the value of his business is not strong enough to pledge for the debt that he's wishing to borrow. And that's called a collateral shortfall. So what do we do about a collateral shortfall? Well, we can add legally, ethically, we can add assets to the client's balance sheet. So their bookkeeping records look better. And now they have the necessary collateral to pledge for the loan. So Joseph then would qualify for the funding because now the lender can see that the business is not insolvent, that it has assets. So when we add assets, it's called the Collateral Support Program. We typically will add $100,000 of assets to the client's balance sheet. Truly add those assets. Here's kind of the example I give, and I think it'll make sense. When we add those assets, we're truly transferring ownership. There's a chain of title, change of ownership. So in this case, Joseph would literally be owed $100,000. It's a true accounts receivable because we're never, ever, ever going to lie on financial records, right? We're not going to lie in general, but we're not going to lie on financial records that are used for funding. That'd be terrible. So Joseph is buying, in this example, a portfolio of $100,000 of assets that he's able to reflect and will help him reflect on his balance sheet. So now he doesn't look insolvent. We've got the collateral enough to match the loan amount. Those assets then are liquidated. So it's kind of like if you and I went out and bought an apartment building. If we just bought an apartment building, but we didn't rent out any of the units, that would kind of be a waste, wouldn't it? Because we spent money, or we're continuing to spend money to pay the mortgage on this building, but there's no money coming in from it. That's horrible. We wouldn't do that, would we? But we might buy a rental property or an apartment building or a strip mall for commercial clients. But we might just stick with the example. We might buy an apartment complex, rent out the units, and now we have what? Positive cash flow. So that's the concept in brief of the collateral support program. For clients that have a shortfall on their balance sheet, we can add the assets to their balance sheet. So now we've eliminated the collateral shortfall. And then we have resources to help liquidate the receivables. Therefore, that creates positive cash flow, just like the renters paying rent to the landlord, that creates positive cash flow. All right, so who has questions on the importance of bookkeeping records? Who has questions, comments, concerns on that? Does that make sense? Do you have questions on that? It's one of those important elements that we teach in the 4-week curriculum, and you should be aware of it as well. All right, so Timothy's asking, and let me bring this up and let me reshare it just to make sure that it's sharing properly. When I bring something new to the screen, I'm always worried if it'll show or not. Okay, so Timothy was asking about the collateral support program. So that's right, Timothy. You can go to Business Paralegal, and that wasn't the point of today's discussion. The point was more so on the importance of record keeping. But here is where the collateral support program is described. There's a little training video. We talk about AR financing. And this is where prospects or clients or whomever can let us know if they're interested in the collateral support program. And then we can send the packet over, they complete it, and then we can create a strong balance sheet very quickly. Again, we've morphed a bit. So we started the call talking about the importance of financial management. And if we are using financial management software, then we can produce the reports that are needed for funding. And if the reports that we generate are inferior, they're not adequate, then there are legal and ethical ways that we can improve the strength of the balance sheet and income statement in GAAP approved, generally agreed upon accounting principles that will allow the business to look strong on paper instead of weak or insolvent. Okay, so who has questions, comments, concerns on the importance of record keeping and or on the collateral support program, which Timothy asked me to bring up here? Any questions, comments? Okay, so Ben's asking about comp. So yes, on the collateral support program, if you wish, you can broker the deals. And so we would call you a debt buyer. Debt buying and debt selling is big industry. It's just a lot of average folks like you and I aren't so familiar with it, because often debt buyers are buying large multi-million-dollar portfolios of home foreclosures, auto repossessions, credit card defaults. Those are the three main types of debt buying and debt selling. Huge industry, legal, ethical, very, very profitable. More profitable than dealing with real estate or cryptocurrency, in fact. So what we're doing is breaking it down on a smaller scale to be able to work with small businesses. And so, yes, if you want to monetize this transaction, you can be a debt buyer. You can buy the portfolio. So it works the same. So you're buying the portfolio, but if you're just a debt buyer, which is talked about here, you're really just buying it at wholesale to turn around and sell it at retail. And so then you can mark it up and make the profit. We've worked with a number. We have Steve, who's one of our brokers, debt buyers. He sold the biggest portfolio that we've sold so far, which was sold to a law firm. And he made tens and tens and tens of thousands of dollars by brokering that deal. So he bought it from us at wholesale and he sold it at retail. So you're welcome to do that as well. If that's too complicated, too involving for you, then don't worry about that. Hannah asked about timing. And so our goal is to get the assets to the balance sheet within 24 hours. And typically that'll happen, but very, very quickly. Because what will happen is once the client has determined that they want to participate in the collateral support program, and we developed this back when I worked for the SBA, because we ran into the same issue then as we do now. But the point is, once they complete the Adobe packet, then we're able to get that portfolio package, get it to them, and support them in getting it on their balance sheet. So Hannah was asking how long. Our goal is to do it in 24 hours. Okay, who else has questions, comments, concerns on what we discussed with the 125 steps? We talked about step number 47 of creating good bookkeeping records using software, maybe like QuickBooks, although QuickBooks has competitors. I think the key in when you're advising a client of which bookkeeping software to use is that if they find some esoteric software that's infrequently used, will their accountant be familiar with it? Because this should provide the continuum. So within our business, we're doing the daily tracking, but we need that data set, that software, to be applicable and usable by our accountants, because the accountants are going to do tax filings and such for us. So I again have no financial interest in QuickBooks, but I think you get into risky territory if you start going off into other software that is less frequently understood by accountants, because you could have a lot more expense incurred for your accountant to have to export data out of your system and import it into theirs. Versus if you use QuickBooks, there's probably about a 99.9% chance that they're very familiar with QuickBooks and they're able to use it without any additional work or new formatting. All right, so who has questions? So we've been working through the 125 steps. Obviously, we're not going through every step. We're hitting some of the highlights. And today we talked about the importance of financial record keeping, talked about balance sheets and income statements, and it's important to generate those. And then it's important to have strong financial statements. And we talked about how the Collateral Support Program can help, frankly, any small business go from having a collateral shortfall to having a strong balance sheet. Now, depending upon the amount of capital raised, we have a number of clients that have bought multiple portfolios because they wanted more assets for more, that had a bigger collateral shortfall. So again, Alfred's asking about collateral shortfall. So what is a collateral shortfall? It is when the business has less assets than the amount of funding that we're looking to obtain. Another example, and this is the one that Joseph and I always talk about because he's in real estate. Let's say you wanted to go buy a house, whether it be for yourself or for rental property, it doesn't matter. House sales price is $250,000. Gets appraised. It's appraised for $125,000. Will the lender finance you $250,000 for that house that only appraises at $125,000? No, they won't. Why? Because there's a collateral shortfall, right? It's because if they loaned you $250,000 to buy this $125,000 house, and for some reason, some instance, you don't pay it and they have to foreclose on it, what do they have? They have a half in that example. They have half the collateral of the loan, of their risk. So that's why when you go buy a car, you typically can only finance the amount of the car and maybe the taxes and license fees. You can't go much beyond that because now the loan is not properly collateralized. Same with business loans. Most lenders would prefer to be able to show on their books that the loan is collateralized. And so if the business doesn't have adequate assets to provide the collateral, that's where the Collateral Support Program comes in to close the gap. So how much of a shortfall is it? Simple math equation, right? Because once you and I look at the client's balance sheet, we can see what their net assets are. And then we can go over and look at how much capital they're looking to raise. And if there's a disconnect between the two, we really have two options, don't we? We can either decrease the amount of loan that we're looking for to go down to the amount of assets we have, the amount of collateral we have, or we need to increase the collateral. Now, there's a few clients that have other assets that they can move into their balance sheet. Maybe they move it from one business that they own to another, or they move personal property onto their business balance sheet. So that can certainly happen. But in most cases, the Collateral Support Program will provide the easiest, the quickest, the most effective way to close that shortfall. All right, well, good information. Thank you for your involvement, your contributions, and your input. And then we will be back tomorrow morning, 8 o'clock Central. Thanks, everyone. Have a great day. Bye.